So you want to learn about the stock market. That's why you clicked onto this video. I'm guessing you're a beginner. You have no idea how to get started in 2020. You don't know about the different strategies, day trading, swing trading, long-term investing, dividend, growth investing, value investing. This stuff is boggling your mind. You have no idea what to do. Well, in this video, my name is Stas, by the way, and in this video, I'm going to be sharing with you all how you can get started in 2020 with stock market investing, trading, whatever it may be. I'm going to be going over the different strategies, how you can actually buy and sell stocks, what do you use, and what is a stock anyway. We're going to go over everything in this video that you need to know as a beginner. So sit back, relax, and let's get into the video. So what is a stock anyway? Are you stocking shelves in Home Depot? Are you stuffing your Christmas gifts or whatever? No, that's not what a stock is, guys. A stock, in this sense, is ownership in a publicly traded company. And a publicly traded company is simply a company out there that you can invest in, right? That you can put your money in, that you get from your job, your side hustles. Maybe you're an entrepreneur, so your business, right? You can take this money and you can buy into these companies through their stock, right? Their stock. When a company goes public, they're private first, so when they go public, they have an initial public offering, also known as an IPO. And this is where you can finally buy shares of stock in that company if you believe in that company long term. So back to what a stock is, it's simply buying into a company that's public. So think Apple, think Amazon, think Walmart, think Target, think Netflix. These are all companies that have initially public offered their shares. They've offered their shares out there, and me, you, anybody out there can link up to a brokerage and buy these stocks and own these businesses and reap the reward of these businesses growing over time. That's kind of the whole goal here of the stock market. And by reaping the benefits of these businesses over time, I mean, think about it, guys. As they're growing, let's use Apple, for example. As Apple's growing, as it continues to innovate and bring more products to the market, like those AirPods that you guys love. I don't own any, but I know a lot of you guys love them since their sales are growing every single quarter. You know, their iPhones, once they sell new iPhones, bring new iPhones to the market, what do? They make more money, more profits, more cash flow, and that benefits me and you if you do own the shares of the company. So long term, that is if you pick a good company, right? That's if you pick a good company, you can reap the rewards of their success. And let's say you pick a bad company, it could also go against you. But let's say you go by Warren Buffett's number one rule, which is never lose money. You're not going to have to worry about that, right? But realistically, you're going to have to worry about that one day or another, but not to discourage you all from investing, because there is a lot of opportunity. There's a lot of money to be made, but you have to realize there is some downside risk to investing, trading, and whatever strategy you're doing in the stock market. So now that we talked about what a stock is and you have a general understanding of just different public companies out there, what can influence a stock's price? This is huge, because a stock, when you open up, let's say Yahoo Finance or whatever news app that you have to look at stocks prices, you're going to see the price of what the market is currently valuing that company at as of right now. Whether it's overvalued, undervalued, fair valued, it's going to be there, and it's your job to figure out whether or not the company is overvalued, undervalued, or fair valued, and that's a bit more advanced stuff. So some things that can fluctuate the price of a stock up or down are quarterly earnings reports, negative and positive news, right? Let's say there's a negative catalyst out there. Let's say on Apple stock, let's say, they get some news that their production is slowing down, their sales are slowing down. This could be something perceived negative, and the stock price of Apple will go down. But let's say they report earnings, and every quarter, guys, every 3 months, a public company gives out their numbers, gives out their performance, so investors out there, people in general, can see how they're doing and decide whether or not they want to put their money into that business, right? So let's say that stock, or rather that business, does very well in one of these earnings reports. Let's say they make a lot of money. Their stock could end up going up a lot, and you can make a lot of money in that sense. And we have a bunch of analysts covering these companies, right? At all of these big banks, all these different, private firms. And let's say one day a big firm comes out and says they've reduced their price target on Apple stock, on Amazon stock, Tesla stock, right? Whatever stock it may be, this could be something that could fluctuate the stock as well. Because let's say there's investors, traders out there, and they see this news come out, oh my God, an analyst lowered the price target. They may freak out and just sell out of the stock, and that will bring the stock's price down. So that's something to consider. And it also works on the flip side, right? Let's say an analyst raises the price target of Netflix stock, Tesla stock. We've seen it in the past. That stock could end up running like crazy. So it's extremely important to know, guys, and differentiate between these different events that can push a stock up or push a stock down, because during these fluctuations, this is actually where you can take advantage of buying into stocks and reaping the rewards, like we mentioned a couple minutes ago, of the business over time. Mainstream media is another thing that could heavily fluctuate the price of a stock. For example, Tesla stock. A couple months ago, mainstream media had a negative light on Tesla, and the stock's price was suppressed. Sure, they had a great earnings report. They had great numbers reported over the past couple of months. Since then, and coupled with the mainstream media turning a positive light onto Tesla from a negative light, the Tesla price has gone up like crazy. So mainstream media, they can really, paint a picture, paint their own narrative around a stock, which could fluctuate the price up and down pretty heavily over a period of weeks, months, and years. So let's say you're a beginner in the stock market and you have no idea what to do. You have no idea how to buy stocks or which stocks to buy, but you know kind of what fluctuates stocks. You know what the basic definition of a stock is. Here's what you got to do. You have to do this, guys. Create a watch list, whether it's on the internet, through any charting software that you use, maybe if you're looking at individual stock charts, or even a piece of paper. Create a list of stocks that you know. Not even stocks, forget that word. Companies. Create a list of public companies that you either use or that you are very, very familiar with. So let's say my 5, for example, would be Apple, Facebook, Amazon, right? Netflix, and let's say another one off the top of my head here, PayPal. These are 5 companies that I'm very familiar with. Now, write these 5 companies down, track these 5 companies, and keep an eye on their stock price, right? And if you see a drastic drop in their stock price, this goes back to a Warren Buffett quote, be greedy when others are fearful and fearful when others are greedy. You could see this drop in the stock price and then look into why the stock price dropped, whether it's one of these that we mentioned a couple minutes ago or something else, and then you can determine, maybe I can buy some of these shares, right? That is where you buy stocks, in my opinion at least. You can chase stocks at all-time highs, but that is dangerous. If a stock's falling down, many people may be scared, but that is where the opportunity emerges because you're getting a cheaper deal. Think about it like this. If you're going to the store and you have a shirt on sale for 50% off, aren't you going to buy that shirt? Well, it's the same in the stock market. If a stock is 50% on sale, why would you not buy that stock? It seems like in the stock market, it's reverse. People see it down 50%, a 50% sale, and they don't buy it, right? They're scared, and they just put their money somewhere else. And that is the biggest mistake. Create that watch list. Watch the stocks, guys. And if you see a massive sell-off in these stocks that you understand, that is when you know you have an opportunity opportunity to maybe get in. Now you have to do a bit digging and see what happened, but you can maybe get in now with this big price drop. That's very, very important. So how can you even buy these stocks anyway? So it's pretty basic now in 2020 to actually buy stocks. Believe it or not, 10, 15, 20 years ago, it was a lot more complicated, and you actually had to pay a fee each time you buy and each time you sell a stock, which added up a lot in just fees, in just cost of trading, cost of buying and selling. That is a thing of the past, because nowadays there's commission-free brokerages, and a bunch of the old school brokerages have turned to commission-free now, which is fantastic. So some that you can use are, let's say, M1 Finance, Robinhood, Fidelity, Charles Schwab, Vanguard, Webull. That's one that I personally use. And speaking of Webull, they're running a promotion right now where if you deposit $100 using my affiliate link down below in the description box, you get 2 free stocks valued up to $1,400. So take advantage of that, especially if you're a beginner. You get free money right off the bat, and you can go and invest that money right into the market with Webull. So it's basic, guys. You sign up, you put your basic information, name, address, social security, all that stuff, and literally within 5 to 10 minutes, you can open up a brokerage account. It's very, very, very simple. Then from there, you put your first deposit in, whether it's 50, $100, and you're good to go. That's all it is. And you go to the search tab, and then you can start typing in different ticker symbols. And ticker symbols, for those of you guys that don't know, this is the unique, phrase, not even a phrase. It's a unique, pattern of letters that individual companies go by in the different exchanges in the stock market, and how you can actually search them up. So for example, Microsoft, its ticker symbol is MSFT. Apple is AAPL. Walmart is WMT. Amazon is AMZN. And once you're in the market for a while, you know all of these names, you can simply just go in, type them, boom, boom, and then you can just buy them $10, $20, $100, whatever of the amount of stock that you want. So now, before we wrap everything up, let's talk about some different strategies, because when you're in the stock market, there's not just one strategy. Let me tell you that, guys. There's a lot of strategies, and me personally, I partake in many strategies in the stock market. So let's go over these, starting off with long-term investing. Long-term investing is buying a stock, buying an index fund, which we'll talk about, or an exchange-traded fund, which we'll talk about, and holding it for a long period of time without paying it any mind. Sure, you have to do some research initially. You put your money initially in, and you continue adding money into it every week, maybe bi-weekly, maybe monthly, and then it's kind of in the background, right? It's passive. You guys have heard passive income. Well, this is like a passive investing strategy. Index fund investing is the most passive, I'd argue, because you're investing in the overall market. Indexes are the S&P 500, which comprises the 500 largest publicly traded United States companies. So let's say you buy an index fund, you're diversified amongst 500 companies, so you're really not having trouble sleeping at night. Let's put it that way, right? And that's very passive. Again, you add it monthly, bi-weekly, maybe every week in terms of adding money into it, and you let it ride, right? Exchange-traded funds, also known as ETFs, these are a bit more kind of personalized because you can pick different sectors and industries to invest in, but like index funds, exchange-traded funds, they're a fund. They're a bunch of stocks comprised in one, so you get that diversity, and it allows you to sleep at night. And why do I say it's a bit more personalizable? Because you can invest in technology ETFs that focus on technology stocks, healthcare ETFs that focus on healthcare, biotechnology, right? There's a bunch of different ones. Financial services with banks, right? You just have to do your research and see what you understand and what you feel comfortable. doing and holding, and you can invest in ETFs like that. And this is, again, very, very passive, and you can sleep well at night doing this strategy, especially as a beginner. You could also go the individual stock picking route, which it's a bit more risky because you're not holding a fund, you're holding just one company or a couple companies that you pick. But this is where it gets fun, guys, because if you really understand a company and you really understand what it does, you can invest solely in that company. But what I don't recommend is investing in random companies that you really haven't done your research on, right? If you're a beginner, there's a high likelihood that you don't really know how to do research and know how to do these things, which I'll make a video in the future about that. And that's why a bunch of beginners just opt to invest in an index fund. Like I said, it's very simple. You put your money in, you don't have to think about it. But with individual stocks, you do have to think about it, guys. Trust me, because I'm an individual stock picker, and I know there's a lot of work behind it, a lot of research, but the thing is, there's a lot more reward, in my opinion, than just simply investing in, let's say, an index fund or an ETF. And with individual stocks, you have growth names, you have value stocks, and you have dividend stocks, right? These are kind of the three categories. And growth stocks, let's do this very quickly, guys, because I don't want this video to be too long. Growth stocks are companies that are really growing at a fast pace. Think Uber, think PayPal, think Amazon, think Facebook, think Square, companies like this. They're growing 20, 30% year over year at a rapid pace. And typically companies like this, their stock price also goes up maybe 15, 20% per year, but it could also get hit harder during tough times. Maybe a recession comes along, this company could get hit. And the thing is, growth stocks, they typically, 99% of the time, they don't pay dividends. And dividends, now that we're on that topic, dividend stocks are, I'd argue, more stable companies. They're not growing as fast as these growth stocks. Let's say they're growing at 3, maybe 5, 7% per year, but they're paying a nice dividend of 2, 3, 4, maybe 5, 6% per year, which is cash flow, guys. This is cash flow, true passive income, and you can take these dividends, this dividend money, and put it back into your stocks and then take advantage of compound interest over time, which is known as the eighth wonder of the world. Value stocks, value investing. This is when you're really looking at companies that, like I mentioned earlier in this video, have fallen a lot. And when companies fall a lot, they get to a good value, which is why they're called value stocks. And value investors, they look for this value before they do end up buying into the stock. And I'll make a video again, like I said, in the next couple of weeks, talking about how you can find value in these individual stocks. So other than long-term investing, you can also do short-term trading, which is what I also do. I actually trade for a living. I make a full-time income from trading in the stock market, and this is mostly from swing trading. I also do a little bit of day trading, but these are the two strategies that people use when they're short-term trading in the market. And I know this is a stock market beginners video. I don't really recommend beginners out there making short-term moves unless they want to learn the craft of trading in specific, but I have to put it in the video, guys, because it is a stock market strategy out there. Although it's very difficult, long-term investing is a lot easier than swing trading or day trading. I still figured to put it in this video because I'd be cheating you guys if I did it, and I personally swing trade and day trade for a living. So I figured I had to let you guys know, right? And day trading is when you're in and out of a stock in one day. You buy and sell in the same day. This very risky. I personally swing trade, I'd say 80 to 85% of the time, which swing trading is you buy a stock one day and you sell it maybe a week later, 2 weeks later, a month, 3 months later, maybe even 6 months later, right? And for me, through my experience in the market, this has proven to be a much safer and consistent strategy than day trading. So that's pretty much it when it comes to short-term trading. Swing trading, day trading, options trading is another one, but for beginners, I 100% do not recommend options trading. You need at least, in my opinion, 2 years of experience in the market at least to dabble with options trading. So I'm not even going to go into that in today's video, but I'll have a video for the more advanced intermediate people about options trading here in the next couple of weeks. So that's pretty much it, guys. I hope I gave you a good rundown of the stock market, how to get started in 2020. Really, the gist of it is understanding that publicly traded companies out there, companies that you use every day, their products, the iPhone, where's my iPhone? It's on the floor, guys, but my iPhone, Apple makes that. The computer, Apple makes that, right? All of these products that you use, not all of them, but many of them are owned by publicly traded companies. Do your research in these companies, guys, and see whether or not you see potential in them long term. And for the most part, you're not going to understand companies that you have no idea about, obviously, which is why you have to look at what you use on a day-to-day basis and what you already know about. If you use Apple, Amazon, you already know for the most part what these businesses are and what they do. Now just dive a bit further in. Take a look at their stock, and this is how you can get involved in the stock market. And once you have an understanding of these companies, again, you can sign up with a bunch of these free brokerages and get started today. And again, Webull is running a promotion right now where if you actually sign up and put $100 in, you get 2 free stocks valued up to $1,400. So don't forget to do that. That is linked down below in the description box. So thanks for watching, guys. Hope you all found value in this video. Hit that like button and consider subscribing. I'll catch you all in the next one. Peace out.